Hello and welcome to another edition of the Mouthy Money podcast. I'm joined as ever by Chris Chute, who is from Financial Communications Consulting MRM. Chris, hello.
Hi Ed, how you doing?
Yeah, good. Busy Monday all round, I think, but we're here to shoot the breeze and read the runes of what's going on in money and the media and all those kind of things.
Quite a bit going on, isn't there?
I know it's getting more and more busy. We've got the election coming up. I feel like there's a lot of things that we're in the queue for stuff that might potentially talk about this week. But we've boiled some stuff down, some interesting things. What are we getting started with first this week?
Well, you had an interesting conversation in the week, didn't you, about things you can learn from other countries about money? That was something that caught my eye.
That's right. Yeah, I actually had the excellent Hope Coombe on the podcast last week. Hope, who is editor of a financial services trade publication called Professional Advisor. I had Hope on basically to talk to me about, well, she's an Australian. She's actually heading back to live in Australia. I just wanted to learn a bit from her about what we could learn from Australians about money. And that kind of got me thinking a little bit harder about what we could learn from other countries in general about money. The main reason being that, I mean, I've lived in a few countries in my life. I lived in Holland when I was a kid. I lived in Argentina for a couple of years when I was a young adult, I suppose you'd say. And I've also
Still a young adult, Ed. Still a young adult.
Young at heart, Chris. Only 35 of them down. Hopefully another 35 at least to go. And I lived in South Africa for a bit, and it kind of got me thinking about, what can we learn from other countries about money? And I mean, I don't want to get too philosophical on it, and obviously these generalizations are kind of, it's easy to get into kind of stereotypes and that kind of thing. But I thought what Hope said was the main thing about the differences between kind of Brits and Aussies about money is Brits celebrate payday more, so they'll go and have a nice dinner when they get paid, kind of thing. And Aussies are very kind of, I think, to a fault almost focused on saving money, which is kind of like, to me, feels like a good problem to have. It's like, oh, so you're really okay, well, yeah. Being a saver doesn't feel like a bad thing, but yeah, it was a really interesting discussion.
Maybe that's something to do with the weather. I don't know. I see. Maybe I've got some Australian blood in me that I don't know about because I'm not a payday splurger. Never have been. I
Really,
quite like paying future me because I'm quite boring, as you can probably tell from my beige shirt. I don't spend all my money on clothes or meals. Don't get me wrong. I do have my own little foibles. Yeah, I like to spend money on football and my family. Probably should put that the other way around, but you know what I mean. But yeah, do you think it's saving to a fault? Do you?
well, I mean, I think there's, being a saver is obviously is a good thing, but then there is the logical extreme of it when you get to things like the FIRE movement and that kind of stuff, don't you? Where people sacrifice all the joy in their lives in order to have, or retire by the age of 40 or something like that, which, okay, it's great if you make it that far, but, I think there's a limit to making yourself miserable. I mean, I will come. This is almost like a Stoics versus Epicureans type discussion because
Which is also very contemporary, weirdly.
I know, yeah, exactly.
That's everywhere as well, isn't it?
I mean, if you're the Stoic, I'm the Epicurean because I like spending on payday. It's a bad habit that I have. What's the word? Like this month, what was it? Oh yeah, there was walk strolling through town where I live, and there was a massive like antique desk. We have like a lot of antique shops in the town that I live in for various reasons, and there was like a big antique desk that was like £185, and I said, "Oh, well, it's payday. I go have a look." I had to measure it up. Turns out it's too big for the space that I wanted to put it in, so never mind. But yeah,
Part of me just absolutely curled up inside there a bit, Ed. Come on, £185 on an antique. Is it an investment or is it just a nice piece of objet d'art?
I mean, I just got at the moment I've got like a cheap desk that I sit at, and it's like, it's about time I felt like the Lord Arbor Nelson when I sat and did my work.
Yeah, where am I going to put my quills on this MDF thing I've got from IKEA?
Exactly,
it's not going to work.
Yeah. Exactly.
Well, life is for living. I do get you on that. I see. This is the thing. It only feels like spending when it's on something that I think probably I'm not that into. If it's like travel or going out with friends and family and that kind of thing, then I don't see it as spending, whereas other people obviously would. But
Yeah.
the payday splurge thing, I think maybe there is always a thing in this, or a quality of life thing anyway, where that's where we all kind of commune in the winter months, isn't it? Or even in the summer months, where it's like, right, we can all go out together. And whereas, I don't know, I've never been to Australia, let alone lived there. So I'm speaking way out of my sort of area of expertise, but I get the impression it's more of an outdoorsy, convivial, joining together culture anyway. So, we're all huddled together in the pub in October, right? Because that's the only time we can spend with each other. Whereas, they're probably down on Bondi surfing or whatever they do. I've seen Neighbours. I know how it works. Something like that.
We're getting into the generalizations now.
Sorry.
No, so I'll add, and this actually leads quite nice into the next topic we were going to talk about today, because Hope did have a view on what she thinks the UK gets right, and she was quite emphatic about that. She said that she thinks that we get fintech right. We're really good at innovating with financial stuff, and I think it's stuff like apps and things like that. So the main one I think we talked about actually was Monzo, and I've always been kind of a big fan of Monzo and other ones like Starling and stuff like that. They really have changed the face of the way we interact on a day-to-day basis with our money. So I thought that was quite interesting, getting an outsider's perspective. We take these things for granted now, don't we? That we have these kind of, do everything on your phone type stuff with your money and everything at your fingertips. So I thought that was quite instructive. And that leads us nicely into the next topic, isn't it? Which is something that from the regulator, which we love to talk about.
Nothing could be more exciting for you listeners on a Monday than your latest dispatch from the regulator. Yeah, but this is quite interesting, particularly if you like your retail investing and if you're interested in, the huge number of different types of investment sites that have come back up, Ed. And I know the FCA have been in touch with some views to Mouthy Money, haven't they?
Yeah. So we got a press release last week from the FCA, who are the financial regulator, looking at the gamification or get concerns around the gamification of investment apps and platforms and that kind of thing, which I think is a really interesting issue. So I'll read you some of the key findings. So what they did was they set up like a test app where they kind of tried out different kind of methods of gamification on a group of 9,000 consumers. And they found some quite interesting stuff, actually.
So sorry, Ed, before we go in, what is gamification?
So it's okay.
How are they defining it?
Yeah. So imagine you've got, you've got your investments on an app or in an ISA or something like that. Then gamification basically is using methods, I think, that are more commonly associated at the good end with games. We're talking about computer games here and mobile phone app, particularly app games. You think of things like Candy Crush and stuff like that. It's all stuff that are techniques that are used to increase engagement with your product. And that's on the kind of the more benign end of it. And the more, concerning end of it, which I think is where the regulator has an eye on, is gambling. Frankly, are these techniques being used, taken from kind of gambling operators and applying to places where they shouldn't be applied, that kind of thing. So some interesting findings in it. So push notifications and points and prize draws and these kind of things increased the number of trades that people made by 11 and 12%. So incentivizing engagement that way. Interestingly enough, women increased their trading frequency more than men because of push notifications, points, and prize draws when those were introduced. Younger participants as well were found to be kind of more susceptible to the kind of the gamification techniques that the FCA tried on them, which I thought was interesting as well. And there's some other stuff about kind of how people at different levels of financial literacy responded to the gamification elements in there. So I think, some potentially concerning findings there.
I think it's quite interesting because while you were talking there, I was thinking about what we're talking about is how almost all of our apps get us to engage with them on our phones to some degree, like the push notifications thing. I have very few apps that I allow push notifications for. One of the things I spend my money on payday, Deliveroo is one, for example, because I want to know where my takeaway is. But aside from that, it does seem a little like, well, it's not just limited to financial services companies, but what's different here, I suppose, are the outcomes that come from those. And the other thing that's in my mind was I've spent 18 years working in financial services communications for various different companies. And one of the things, particularly in the investment side of things, that companies struggled with for a long time was making themselves more relatable, making people more willing to engage with them. And actually, I think some of the new arrivals and companies that have sort of done this quite well have opened that up a bit more by making it more accessible. And that's back to the fintech thing you were talking about, Ed, which is making it easier at our fingertips to make trades and to understand, get a bit more information to hand, and to um, see our progress, not quite in real time, but near as damn it, I suppose, in a lot of cases. And there's positives to that because money is higher up, people's thought processes are more center of what their thought process is. But actually, when you start thinking about the Candy Crush element to it and getting a little bit more cynical with dopamine releases by balloons going up or flashes on the screen and things like that, I think that is where things are probably a little bit more murky. And all of these things, if they're designed to get better financial outcomes, get people more engaged in what they're doing, then I think that can only be a good thing. But then there does need to be a line drawn somewhere. And what's quite interesting with this FCA thing for me is it feels like they're attempting to draw that line in a bit more sort of bold pen mark, if you like, and say, actually, here are the areas where we're a little bit more concerned. But there are loads of companies that have done that kind of freshening up, that being creative rather than cynical with this kind of stuff. And, like a Nutmeg, Wombat, Plum on the investment side have really kind of engaged consumers really, really well using these, not those kind of techniques, but, thinking more about what is likely to capture people's attention, garner their interest, make them more energized to think about money. But it's being energized in the right direction to do the right things. And if it's encouraging us to make trades that ultimately are going to lead to worse outcomes, then I think this is the job of the regulator to work out where those lines are and move with the technology. So it is quite interesting. And some of those stats you mentioned were eye-opening, I think.
Yeah, I think it's a spectrum, isn't it? Because at one end of the spectrum, you've got companies that do absolutely nothing to get their customers to engage with them, and the kind of the worst offenders tend to be in that, things like pension providers and things where you just kind of sit and rot on something for 30 years and nothing gets done. And then you've got the other end of the spectrum, which is obviously what the FCA is really kind of keeping an eye on, which is, creating excessive risk by pushing people into doing things with their portfolios and investments that they perhaps not in their best interests. And I think it's finding that middle ground between those two, isn't it? And I mean, I always remember one of my kind of favorite examples was always Moneybox. And I remember talking to them years ago about how successful their campaign, I don't know if they still do it, but their campaign that they used to do was just the rounding up your spare change functionality. And I remember them telling me that, it was such a powerful tool because it's like, it's just such a simple idea. And actually everybody, like I mentioned earlier, companies like Monzo do it now as well, where you just you have stuff in place, and Plum will do it too. Lots of them have got it. But that kind of round up your spare change is such a simple idea, but it's super effective. And then they'll get a client that way because the client's like, oh yeah, that's a nice idea. I get to save without even thinking about it. And then you've got somebody, in your app, and then it's what do you do with that kind of thing? And then you talk to them about, okay, well, this is what you should be doing, and that kind of thing. I think those robo, apps, I think as they're called in the industry, have been generally, really good. They're changing the way, the language of which, the visual language, not just the actual, words, but the visual language to approach investing. It's about making it so that anybody can look at it and think, okay, well, this is something I can access, instead of making it look like a jargon-filled mess that it just scares people away or whatever. But I think the outcomes of the gamification stuff will be interesting once we do see it.
Yeah, the nudging is important towards, and you think the word you use there is saving, and that's very different to gambling, which what I think is what gets levelled at these, and even the sort of the gambling firms now, you've noticed the way that they're kind of advertising if the fund stops, stop, and all that kind of thing. They're very keen to. They realise that the barriers to entry to this stuff, or the resistance to this stuff, is perhaps not as much friction as it needs to be for people who might be more susceptible to that kind of thing. But then you kind of get into the conversation about, how much personal responsibility is involved in those things, et cetera, et cetera. But as financial services firms, and people who work for financial services firms, well, I'm one of those people. You do need to think about that and your responsibility around that, and whether you're encouraging good outcomes or bad outcomes. That's what it kind of boils down to. And if the outcome is throwing your money into a virtual, glass jar with your loose change, and at the end of a year having something that could be meaningful in terms of helping you financially, versus do you want to gamble with your stocks? Yeah, there is that's a line that seems quite clear to me, and it's good that it's being more clearly defined, I think.
Yeah, so staying on the topic of young people, because obviously this is kind of one of the big takeaways that are effective. We do have some mortgage market news, don't we? This week?
Well, yeah, it's been big, hasn't it? We did talk last week about much anticipation about what the Bank of England's Monetary Policy Committee was going to do with base rate and whether or not there'd be a cut. And there was a lot of discussion previously. And after all the much ado, it was about nothing because there was no cut. That wasn't entirely surprising for anyone who's watching the market. And I think we alluded to it previously in our last discussion about it. But that does obviously have very real impacts for people who are paying mortgages. And I mentioned that I'm in the process of looking at my own. So it's a bit of a complicated situation with the way that my loan is structured, actually. But I won't get into that. It's a hangover from how I moved into my current property from my last one. But September is the cut-off point for me, and I did quite helpfully, talking about push notifications, get something through from Santander saying you're locked into a deal, but you can change it anywhere up to 14 days before, which is good, and you should keep checking for rates, etc., etc. So I would definitely give them a pat on the back for their sort of direct email comms to their clients there, because they're giving me a good steer. But yeah, that does kind of lead us up to what that might mean for the wider market. Rates are staying high for now, and cuts do seem likely to come, but we don't know what the new normal is. And a lot of first-time buyers will be hoping that the new normal that was reported in The Guardian today is not the new normal, which is for the first time ever, first-time buyer mortgage repayments are topping, I think it's an average of £1,000 per month, which is quite the chunk of change. Did you see that story, Ed?
Yeah, I mean, it doesn't really surprise me that first time buyers who are going to be on higher loan to value ratios anyway. I mean, speaking as somebody who was a first time buyer 2 years ago now, we benefited from, well, Rishi Sunak was Chancellor at the time, and he did the 95% mortgage guarantee scheme, which we benefited from. We got on the property ladder with a 5% deposit, which was amazing and meant that we were able to get on more quickly. As a result, we have probably a higher monthly mortgage payment than we definitely have a higher monthly mortgage payment than we would have done on a 10%. But I saw an interesting graph actually on Twitter the other day. If you look at the increase in rate on first time buyers, it's kind of steadily trickled up. And if you look at the overall average mortgage market rates, so that's what everybody's on average, it's following at a really big lag. So that is to say, there's kind of, interest rates have gone up, but it's still going to take a long time for that effect to feed through. And even if stuff starts coming down again, actually, the effects are going to be with us for quite a while. And I think the interest rate thing is it's starting to look a bit problematic, because the Bank of England last week, they held rates, which both you and I we both predicted successfully, which I'm extremely proud of. Wasn't difficult at all, obviously. The immediate response from quite a few places was that the Bank of England, or the MPC, were holding rates for political reasons. And people saying, well, you should have cut rates, but you haven't done because you don't want to be seen to be backing Rishi Sunak, because cutting rates now is theoretically a good thing for Rishi Sunak, despite the fact that cutting rates is an implicit acceptance of the fact that the economy is stalling. So this is kind of a mad backward world that we live in now, where I don't think there's any indication that they did actually act with kind of political intentions in mind. But I would say that whoever's in the next government, it's politically going to be in their interest for rates to start coming down and easing conditions, and as soon as those rates do come down, because they look like they will, whoever's in power will benefit from that as, remortgage rates and all this kind of stuff starts to get easier. So,
Yeah, to put my political hat on, and I'm quoting directly from Kaylina Markotov's article in The Guardian today, but the numbers that have been crunched here said that over the last 5 years, so since the last general election, the average mortgage payment for a typical first-time buyer in Great Britain has risen by 61% to £1,075 a month, up from £667 in 2019, according to Rightmove, actually, so that's where the data has come from. Yeah, I mean, it does feel like the blame, if there is to blame, to be apportioned to the vagaries of the mortgage market from a political standpoint. This is not helping. If you're of the true blue political variety, this is not helping your case, I think. But you're right. I think there will be a settling down of this once we get past later into this year, and we will start to see things starting to tick down, and that will have an inevitable political benefit, I think, as people get a sense in their pockets over time that mortgage borrowers are not the full extent of the country, I appreciate, but they are an important electoral group, and so they will definitely feel the benefit of that, I think, Labour, if and when they do win, which is what we're thinking. But it does beg another question. We touched on this before as well, about what is the new normal going to be then? Because is the new normal mortgage costs soaring 60% every 5 years, in which case that's not ideal. I don't think it is, but we wanted to get into this in a bit more detail, didn't we? So we've got a mortgage takeover week coming up there, don't we?
Yeah, that's right. So, I mean, the main thing here actually is that for the longest time, the mortgage market and, looking at mortgages was actually quite a dull activity.
Speak for yourself, Ed.
Oh, okay. Well, because interest rates were so low for so long, the activity in the mortgage market was limited, and the competition and, for potential mortgage borrowers was, pretty marginal, right? You're kind of debating the difference between a 2% and a 2.2% mortgage, or whatever it was back in the, halcyon days. But because rates are up now, things are starting to look more interesting, and there's more competition out there, and there's more going on, basically. So with that in mind, we are having a mortgage takeover next week on Mouthy Money. What that means in practice is we've got reader questions, which we fielded. So we're going to get some experts answering some really good, juicy mortgage questions, ranging through all sorts of different stuff that readers have got in touch about. We've got some mortgage experts writing for us, some guest blogs going up, talking about what's going on in the kind of mortgage market, what people need to know. And then we've got a couple of podcasts coming up with some guests. Who are the guests we've got on, Chris?
We're speaking to a few at the moment, but at the moment it looks like it will be hopefully someone from Tembo, the online mortgage broker. So they help people find deals, which is good. And then we've got a couple of lenders, Perenna and West One, who lend to first-time buyers and all types of different people, actually. First time, second time, third time, if you're lucky enough, as well as offering other things. So they've got a good holistic view of what's happening across the market for even people like buy-to-let investors as well, if we want to go down that route. So, yeah, hope those are three of the names. There'll be more, I'm sure, of who we're going to kind of try and get this sense of. But it is quite interesting as well from a sort of structural point of view. So it's not just where's the best deals. Like, if it stays higher for longer, what's that going to do to house prices? What's that going to do to the availability of housing stock? Like, Labour came out in the manifesto and said that, building new properties is a big part of what they want to do. And I know there's a lot of all political sides that appreciate the need for doing that. There's a practical issue here around where are they built, how are they built, planning laws, all the rest of it. So we don't want to get into that necessarily. But if the costs of borrowing are higher, then that's going to make it more difficult for people to actually make the jump. So what does that mean for the availability of housing stock, the future of house prices? What does it mean for our personal finances in terms of regular mortgage repayments we've got to make, and how do the lenders respond to that as well? So we want to try and get that from the horse's mouth, I think. So it will be interesting. It will be a bit more than just here's your best rate. If you want that, then obviously we can help you with that, can't we, Ed? But it's maybe understanding what might be happening in the next 18 months, 2 years, 3 years, 5 years, and how that might impact you, and just being aware of what those things look like, really giving Mouthy Money listeners and readers a chance to get their head up a bit more and plan a bit further ahead.
And I think what matters here for kind of the readers and who we speak to, people who ask questions and that kind of stuff, is exactly what you say there. Because mortgages are similar in that sense to pensions, where, you're not just, when you take out a mortgage, it's not just like, buying something off the shelf and then, you use it and forget about it. A mortgage is something which, notionally stays with you for 25 years, and you have to make fairly fundamental financial decisions around that mortgage, when every 2 years, if you're on, 2-year fixes, 5 years or 10 years, it's something that lives with you for a long time. So it's something that's quite important from a kind of consumer perspective, from people who are, on the property ladder but have a mortgage, or looking to get on the property ladder. It's quite a fundamental decision to make when you decide what to go for, and it has, very big implications for all sorts of stuff. Whether you can have a mortgage that helps you pay or overpay, over a certain amount of time, one that offers kind of better rates or is structured in a specific way to help you. It's a complicated area, so I think what we want to do is really dig down into some interesting stuff around that, and yes, see what we come up with, I guess.
Yeah, it's a big deal, right, for all of us. And so I think we do need a level of, I like to think that, the more I know about it, the more likely I am to be able to prepare for anything that might come down the line and make sure that I'm best suited. Because your mortgage is like turning a tanker, really, isn't it? You can't make snap decisions about it. It's not, jumping from one savings rate to the next. And like you said, while rates were low, it did seem like it was pretty straightforward. But if they're not going back that low anytime soon, then it'll always be a rate-driven decision to a point. But the more you can understand what the implications of that are for the future, and what that might mean for the asset that you're backing that mortgage against, and what it might mean for the wider economy and things like that, I think are all really, really important questions that, I personally like to have a bit more understanding of. So I will be tuning in.
Lovely. Well, I think that just about wraps us up for today. Chris, thanks again as ever for
My pleasure.
joining me.
Thanks, Ed. Thank you.
And we'll be back again soon. And when you check us out on Mouthy Money next week, we'll have all that more good mortgage stuff going up. So keep an eye out. And of course, all the usual this week with the newsletter, competitions, everything else. You can follow us on Spotify, YouTube, Apple Podcast, and of course, check out the website with the newsletter and everything else. With that, thank you, everybody, and goodbye.